There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB this Tuesday afternoon. I'm Juliette Sarley. Great to have your company as we see out another day on the market. And we did see a little bit more momentum, I guess you could say, to the upside in the last hour of trade, but we're still closing down 0.5%. Today we had CBA coming under pressure. We had all the banks really fall. We'll get into ANZ in a second. And also the fact that CSL was ex-div kind of weighing overall on the overall market. Energy stocks also a little bit under pressure. Woodside and Santos down too. So let's get to the themes of the day on what was really a under pressure session for the local market, and also a little bit of caution over further cuts from the RBA. That weighed on consumer sentiment according to the latest Westpac Melbourne Institute survey, which saw that consumer sentiment eased back from that 3.5-year high that was reached in August. It fell 3.1% in September to a reading of 95.4, with consumers less confident about further rate cuts. Meanwhile, Australian business conditions did improve in August with cost pressures easing. So all of these adding to the likelihood the RBA will hold rates steady on September 30. I'm still getting used to these weird dates that the RBA meets now. And 66 cents, the Aussie dollar, I think it's about 66.1 at the moment too, up 11% or so from those lows it reached on April after Liberation Day. So we're continuing to monitor all of the FX moves as well. Let's have a look at where the banks finished up, particularly with ANZ announcing 35 job cuts. The Financial Sector Union calling this an unhinged move. NAB looked okay. CBA, though, weighing on the index, down 1.4%. When we look at the retailers, particularly after that consumer sentiment survey, JB Hi-Fi looked okay. And there was some news out there as well on JB Hi-Fi with the likes of the beneficiary of JB Hi-Fi. I think it's the Good Guys. Let me just quickly find this. It had a little bit of news out. Yeah, paying $13.5 million in fines. And this is for misleading shoppers in relation to some of its store credit and promotions, according to a federal court ruling. Harvey Norman down 1/3%, Premier Investments and Myer under pressure as well. Gold hit a record again overnight. You've got Evolution and Northern Star looking good, but Newmont pretty flat there. And when it came to some of the news we were following, of course, ANZ shedding 3,500 jobs, taking a $560 million restructuring charge. Nino Matos, the new CEO, saying that there could be more ugly changes to come. But they did say the restructure was a last resort, despite the fact that the FSU National President, Wendy Street, says it's not a strategy, it's pure corporate vandalism and feeding greed. Westpac also under pressure. Morgan Stanley saying it's its least preferred of the big four. BHP there settling its Samarco class action, agreeing to pay $110 million. Genesis Minerals receiving approval for one of its mines in WA, and Telix, this is a good news story, reaching an agreement with the US FDA to resubmit its application for approval for its brain cancer imaging agent. And you'll remember earlier in the year when the FDA said no deal, that Telix shares did get punished. All right, let's make sense of the day, and welcome to the COB, Martin Crabb from Shaw & Partners. Good to see you, Martin.
Good to see you too, Juliette.
So is it the banks and CSL, or why are we not doing so well today?
Yeah, I mean, I think people are a bit panicked about this currency, right? So clearly the direction of rates in America is probably they're going to fall faster than the Aussie. So on our numbers, about this time next year, our rates will be above their rates. So more and more money's going into the A dollar. And obviously iron ore at $107 a tonne as well. So both of those are very positive for the Aussie. So we can just see our rates. We're looking at 2 more cuts, but an increasing number of economists are going to say we're one and done because the economy is quite strong, notwithstanding the slightly softer consumer sentiment. The economy is growing in nominal terms about 5%. So that's no need to cut rates aggressively. However, in the US tonight we're going to get this big payroll revision, right? We saw one a year ago. So the government gets all the tax receipts and goes, hang on, have we got this many payrolls? Why aren't they paying tax? So they revise the number of payrolls, and it'll be down by between 500,000 and 1 million, most people are saying. So that economy is slowing faster than people think, and therefore the interest rate futures curve is shifted lower in the US, saying that if the focus of the Fed's now less on the tariffs and inflation and more on the weakening labour market, they're going to get to neutral quicker. So neutral, there's probably 2.5 to 2.75. Neutral in Australia is probably 3 something. So again, we're looking at higher Aussie rates than US rates, and that means people buy the Aussie dollar because they can get more yield on it, right? So I think anything that's got US dollar earnings, and there's a lot of stocks in Australia that do, not just the miners, but your CSLs, your Amcors, your Brambles, there's lots and lots of stocks. So you can see there the crossover is going to happen, August next year. We're going to have Aussie rates above US rates. So a lot of the weakness today I'd put down to the strength in the currency, and we are just seeing rotation out of global stocks into local stocks, because the view is if the US economy is slowing and the Aussie economy is resilient, that's got implications for large caps, small caps, but also domestic stocks versus global stocks.
When you talk about domestic stocks, I mean, you've seen some data here that shows how hard it is to beat the index as well. What does that tell us? Yeah,
there's a thing called the SPIVA report, which Standard & Poor's put out on a regular basis every quarter, just looking at active managers. And look, there's lots of studies that looked at active managers versus passive managers. And I suppose it just brings home how hard it is to beat the share market. The share market index is made up of the biggest, most profitable companies are the biggest companies. Companies get put into the index after they've started to go up a lot, so it's long momentum, it's long profitability, it's long quality, it's long size, and all of those factors tend to be really, really hard to beat if you're an active manager. So, I know from personal experience how hard it is to beat the index, and so a lot of investors go, you know what, it's too hard, I'll just go passive, I'll just buy an index fund or an ETF that tracks the index. You are guaranteed underperformance if you do that, because you're still got to pay a fee, right? But it is really, and the longer term numbers are that over time, 80 to 85% of active managers don't beat the index. So you're swimming in a very small pool if you're an active manager that can beat them. Now, that doesn't mean you can't do it, it's just hard. Whereas if you look in bonds, it's the index is made up of the biggest borrowers. Yeah, they're not the companies you want to own. The bigger they are, the more debt they have, the less you want to invest in them, right? So the bond index itself is made up of riskier borrowers, if you like. So active managers tend to outperform the index in the bond markets. It's the opposite of the equity market. I think 70% of managers outperform the bond index over sort of 3 to 5 year periods. But however, a lot of investors are passive when it comes to bonds. They go and buy an ETF. So you're almost better off doing the opposite, right? Going passive on equities and active on fixed income. Certainly within the Shaw and Partners portfolios, we're looking more and more, how do we get active managers for our bond portfolio rather than passive?
And when you're looking as well, more broadly, are you looking at small caps?
Yeah, it was interesting. One of our providers for research at Shaw and Partners just put out a note this morning saying time to get long small caps, and we think small caps are really attractive. They do also tend to outperform large caps in a rate cutting cycle, and even though we only think we'll probably get 1, possibly 2 more cuts, there's still a lot of runway for there. So just looking at the ASX Small Ordinaries divided by the ASX 100, so the Small Ordinaries is stock 101 down to stock 300. You can just see that since reporting season finished, small caps have really started to outperform. In fact, the outperformance is over 10% in that very short period of time. So we're just starting to see more managers allocating to smalls. We like smalls. I mean, as a house, Shaw and Partners have been saying buy small caps over large caps for a while. Some of that's due to the fact that the large caps is banks and miners, which don't really have a fantastic growth outlook. So to really get that growth outlook, let's go down the cap level. Let's buy some smalls. The other thing is there's more domestic cyclicals in the small caps, and that's where you want to be at the moment. We think the domestic economy is doing okay, and so you want to be out of the big caps, the miners and these sorts of stocks, and into some of the smalls. That's definitely the way to go.
And I noticed Greatland Resources, which is in the small ords, and I think the ASX 300, also going into the ASX 200 in this rebalance. So there's some really interesting names in that rebalance.
Yeah, that was massive, wasn't it? So I think there was 3 in and out of the 100, which we tracked pretty closely. So you had Ramelius and Genesis Minerals. So again, another 2 gold stocks. Now got 6 gold stocks in the 100. If you go back 2 or 3 years, there was 1.
Yeah.
It was Newcrest. That was it. Now there's a heap of them. And then as you go down, like the 200, the 300, there was like 15, 20, 25 changes. So S&P, ASX has made a lot of changes to that. But gold has done so well, Juliet. It's now a bigger part of the market, and it's graduated back up into the top of the indices as well.
Yep. All right, Martin, always appreciate your insights. Thanks so much. Martin Crabb from Shaw and Partners. Sticking with thematics and, of course, looking at equities, the stock of the day was Telix Pharmaceuticals. Nadine was joined by Luke Larative from Seneca Financial Solutions, Andrew Coleman from Team Invest for their view.
You know, playing the FDA game can be a bit hit and miss, or very hit and miss, or really hard to do consistently. I think Telix is kind of the opposite of Neuron. So, like, you know, Neuron, you're getting a product that's already up and running, already growing, already doing quite well, and the market cap covers that, and you get the second product for free, or, you know, the upside from the potential second product for free. Telix has got one product, and then the market's really pricing in kind of the sales from the second product, and that's why the share price has fallen. Is, you know, that hasn't quite eventuated as the market was expecting, that approvals process.
It's a biotech that is again back to its historical ways of not making money. They've got debt to equity of over 100% now, trying to fund the next iteration. They're busy and have been doing capital raises year after year. Biotechs, with the exception of a couple, and we talked about 2 of them today in Clinuvel and CSL, tend to be not very good investments, even though they do wonderful things for the world.
A down day today, but let's have a look at some of the leaders who tried to push us higher, including Vault Minerals up 5%, IDP Education up by 4%, Megaport, Capstone Copper and Imdex looking good. To the downside today, Polynovo, HMC Capital, Premier Investments, IPH and Pinnacle Investment. And just talking about that rebalance, Polynovo will be excluded from the ASX 200 come the end of September 19. To the small end of town, Cettire had a great session, up by some 15%. Echo IQ also looking good there. To the downside though, Zeotech down 9.5% and Gorilla Gold Mines down 7.5%. Tonight we get the US NFIB Small Business Optimism Index for August, which could dip about 0.3% from a year ago, while we'll also have earnings from Oracle, Synopsys and GameStop. Gosh, remember when GameStop was the big stock of the day a few years ago? All right, tomorrow we get China CPI and PPI, and of course I had that great chat with Randa Xiaopeng from ANZ saying that they do think both those indexes will come out of deflationary territory by 2026. Ex-dividend includes Brambles, IDP Education, Medibank and Regis Resources. The local market, though, finishing the day lower by 0.5%. CBA really dipping along with all of the banks, but Life 360 did rally. Iron ore surged past $107. BHP settled that class action. And of course, as Martin pointed out, the Aussie dollar at 66.1 or 2 cents, very much seeing a bit of a weakness coming through from some of those stocks on our market that are exposed there to the greenback. We will do it all again from 9:45 a.m. Eastern. Have a great night and we'll see you tomorrow.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.